people have gotten pretty bearish in the last couple of weeks because the government shutdown kind of has deprived the economy of money. And then the Treasury Department isn't dispersing funds, so their liquidity has shrunk. And it's caused stocks to actually wobble. I think, first of all, bullish sentiment is not even anchored properly. People become so hesitant. I think everybody thinks there's a top. Here's the thing. When everyone says there's a top, there cannot be a top. Keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now, that meeting's not for a few weeks, but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well.
Every market cycle reaches a point where fear drowns out reality, sentiment shifts, liquidity tightens, and prices stall. Right now, we're hearing the same refrain. The top is in, the boom is over, AI stocks are rolling over, crypto's dead again. But history tells a different story. Real tops form in euphoria, not fear. And today, fear dominates. That's exactly why Tom Lee, co-founder of Fundstrat, remains bullish. Lee acknowledges the challenges, tightening liquidity, wobbly equities, and political uncertainty, but he's focused on the macro picture. Inflation is softening, AI growth remains strong, and the Federal Reserve is nearing an easing cycle. If a December rate cut hits, it could unleash massive momentum across small caps, tech, and especially crypto, which has historically rallied hardest when financial conditions loosen. Despite recent price fatigue, Lee believes this isn't weakness, it's a setup. Institutions are underexposed, liquidity is returning, and assets tied to growth and innovation, like Bitcoin, Ethereum, and digital assets, stand to benefit most. His message is clear. Ignore the fear, see the structure, and position for the inflection point everyone else is too afraid to believe in.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
Well, I think what people have a hard time understanding and grasping are super cycles, because Fundstrat's work by nature is thematic. We look for story arcs that last 10 to 15 years. So the reason we turned structurally bullish in 2009, was because our cycle work showed that there was a long-term bull market starting. Beginning in 2018, we identified two future super cycles. One was millennials, and the fact that they're entering the prime age workforce. That was a powerful tailwind that would last up to 20 years. And the second was there was a global prime age workforce labor shortage. I know it sounds like plain vanilla to say that, but that was going to set the stage for an AI boom. So we're in the midst of an AI boom that is causing prices to levitate. But this is pretty textbook. In 1991 to 99, there was a labor shortage and tech boomed. 1948 to 67, there was a labor shortage and tech boomed. So tech is booming, and a lot of people look at stocks that have a high Sharpe ratio, right? They're just going up, and they assume it's a bubble. And so people have been chronically trying to short NVIDIA every step of the way up. And then the second thing people anchor to is that, well, many people aren't really that old in our business. I was actually an equity research analyst during the dot-com boom. So many people are saying this is just like the dot-com mania. There's some similarities, but we're so far from it. But everyone thinks that this is big again. I was actually helping doing the wireless sector. So they were part of that build out of the fiber and the cellular towers and the internet. I remembered that data networking analysts asked me, Tom, what is TCP IP? Because, wireless companies had to do some basic architecture. So this is very different because AI, of course, is gaining function. Internet wasn't gaining function. There was just a lot of spending. So the thesis in telecoms back then, because people forget, because telecom was the CapEx boom, not internet. In the emerging markets, telecom spending was associated with GDP growth. So there was an emerging markets thesis around telecom spending that was in the mid-90s. But then that spilled over into the US digging up a lot of fiber everywhere, on the railroads, on the streets. Many people were young, but they, Quest and everybody was laying fiber, and then they were laying fiber across the world with Global Crossing. The problem is internet consumption of that was not at all keeping pace with the explosion of the amount of fiber being laid. There was almost 99% dark fiber at the peak. Now, NVIDIA GPU usage, as you're saying, is pretty much 100% usage the minute they turn it on. It's a lot more like the Cheesecake Factory, where when Cheesecake Factory opens a store, it's at 98% capacity.
If NVIDIA could increase capacity by another 50%, they would still sell out of every single chip.
That's right, because as you know, today there are 3 really binding constraints. It's NVIDIA chips, it's actually silicon surrounding it, and then it's energy, and all 3 are constrained. And then it's really not, maybe not the best word, but the gain of function of AI is actually progressing faster. So there really right now is capital spending is behind the curve. Well, number one, as your viewers know, people have gotten pretty bearish in the last couple of weeks because the government shutdown kind of has deprived the economy of money. And then the Treasury Department isn't dispersing funds, so their liquidity has shrunk. And it's caused stocks to actually wobble. And every time the S&P is down 2 or 3%, or AI stocks are down 5%, I think people get really cautious. I think, first of all, bullish sentiment is not even anchored properly. People become so hesitant. I think everybody thinks there's a top. Here's the thing. When everyone says there's a top, there cannot be a top. The top in the dotcom was because nobody thought stocks could ever fall. They actually thought we were entering like an era of continued prosperity. The second thing to keep in mind is that markets have been strong for the last 6 months. There is incredible demand for equities because people are really off sides. That's what you have to keep in mind. In April of this year, people thought we were facing Armageddon because of tariffs, and you had many economists proclaiming a recession, and that's how institutions traded. They were actually positioned for a massive bear. They can't fix that in 6 months. So we're now getting into year end where institutions, 80%, are trailing their benchmark this year. It's the worst performance for institutional fund managers in 30 years, and they have 10 weeks to fix it. They're going to be buying stocks. And finally, visibility for AI has not even been affected by the government shutdown or anything. So companies are going to start, as they think about 2026, start making announcements. So I think in the final months, I think one surprise is the AI trade's going to come back strong because it's wobbled. But the Fed is getting people scared because is the Fed going to suddenly hammer down on things? But keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now that meeting's not for a few weeks, but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well.
Tom Lee's key argument is that we're in a super cycle, not a bubble, a long structural trend driven by demographics, labor shortages, and technology. He sees the 2010s as the start of this sustained bull run, now powered by AI, where demand far outpaces supply. Unlike the dot-com era, innovation cycles refresh in months, not decades, which is why fading NVIDIA or crypto has failed repeatedly. Institutions, however, entered 2024 expecting a recession. After years of defensive positioning, they're now massively underexposed as markets climb higher. With only weeks left in the year, that misalignment is creating intense pressure to catch up. And as Lee points out, when big money chases performance in an easing environment, capital flows into assets with asymmetric upside, like Bitcoin and Ethereum, setting the stage for their next major move.
Well, I think people have dampened their expectations for Bitcoin partly because Bitcoin's been treading water. And there have been a lot of OGs, original Bitcoiners that are selling above 100,000. But it is still an underallocated asset class. So I think Bitcoin actually potentially can get to the high 100,000s, maybe even 200,000 by the end of the year. I think it's a big ask. But to me, what's more obvious is Ethereum can have a huge move into year end because even Cathie Wood wrote about it. She thinks stable coins have been cannibalizing demand for Bitcoin, and gold and tokenized gold is cannibalizing demand for Bitcoin. But stable coins and tokenized gold run on smart contract blockchains like Ethereum, and Wall Street is building, and Larry Fink wants to tokenize everything on the blockchain. That means Ethereum is where people are starting to raise their growth expectations. And if you're raising your growth expectations, then your discount to the future is going up. So I think that there's a bigger move in Ethereum, and Mark Newton, our head of technical strategy, thinks we can be like 9 to 12,000 by January. I think that's about right. I think Ethereum, just 3,600 more than doubles between now and year end, or between now and January.
Do you think that that also spills over to cryptocurrencies as far as Ethereum and Bitcoin, that institutional participation?
Yeah, I do, Tom. One thing you're pointing out, and that's correct, is that 2025 is the third year where the S&P will be up double digits, probably up 20% this year. So 3 years of 20% gains in a row. Okay, remember at the end of 2022, people were saying we were Armageddon. Nobody was bullish. So in the last 3 years, wealthy individuals and hedge funds recommended people go to cash, or they do alternatives like private equity, private credit, or venture. But the S&P 500 has trounced all of those categories of assets. This is a comeuppance because, 3-year return, what is someone's excuse for basically maybe having flat performance or up 15% when the S&P is almost, up 200%? So this is really the reason 2026 is probably not as bearish as people think, because now next year, I think people are going to be like, wow, wait, NVIDIA and all these are public companies and their earnings are growing 50%. I think people are going to actually start chasing them next year. That's really positive for crypto because, as you know, there is also this argument today that the crypto cycle is a 4-year cycle, so it should be ending now. So people are trying to fade that. I think people are trying to fade everything, the S&P and the crypto, but forgetting that the Fed is beginning to cut. And the ISM, and we've written about this, is more correlated to Bitcoin than monetary policy. And until the ISM gets to 60, Bitcoin really can't peak. So I think this is pretty positive for crypto. But crypto, it's kind of been hurt because, monetary liquidity hasn't been really increasing. The Fed has been under QT, quantitative tightening. That's ending in December. And the Fed hasn't really given clear signals that they want to ease. So I think there's been a little bit of confusion for investors. I would say if I had to say what is the most overrated risk, I think the most overrated risk is that inflation's coming back. But the reason I think it's overrated is I think too many people think monetary easing cycles create inflation, or they think GDP growth creates inflation. But inflation is a very mysterious thing because we had a lot of easy money for years and there was no inflation. And now that the labor market's softening and the tariffs basically were supposed to create another wave of inflation, it hasn't. And housing is now tanking. How do we get inflation if the big drivers are housing? The big drivers of inflation are housing, labor costs, and then goods. But none of those are inflating. I heard a Fed speaker last week say core services is inflating again. We checked it. That's dead wrong. PCE core services is now running at 3.2%. It's been long-term 3.6. It's actually running below average. And core services generally runs above 2% because goods offsets that. So I think that there's a false belief inflation is actually strengthening.
What about a curveball that comes from oil? Let's say geopolitics, wars, supply chain, oil shoots up. Could you see a scenario where this makes you bearish if that happens?
There is a possibility. Oil, if it goes high enough, can create a shock. And so if you look at the last 3 cycles of shocks, inflation shocks, the last 3 non-Fed related economic shocks were commodity shocks. But oil as a burden has to become meaningful to households. So, in the last few years, the energy intensity of the economy has actually shrunk. So oil needs to get close to $200 to create that shock. You know, $100 oil, we got close to that. It doesn't create the shock. You really need to be getting. So could oil triple on a geopolitical? Maybe, but remember, this summer the U.S. bombed Iran's nuclear facilities, and people had said that if the U.S. ever bombed Iran's nuclear facilities, oil would spike to 200, and it barely budged.
Tom Lee believes Bitcoin expectations are far too muted. Despite sideways movement and profit taking above $100,000, he says the structural setup remains strong. Bitcoin is still one of the most underallocated institutional assets. With the Fed turning dovish and liquidity bottoming, Lee sees conditions aligning for a major rally, projecting $150,000, $200,000 by year-end. But his bigger focus is Ethereum. As stablecoins and tokenized assets surge, demand for on-chain infrastructure is driving Ethereum's growth. Fundstrat's Mark Newton even targets $9,000, $12,000 by January, which Lee calls realistic given easing policy, institutional rotation, and accelerating blockchain adoption. With inflation cooling, AI productivity rising, and liquidity returning, Lee argues the super cycle is alive, and crypto is entering its next major breakout phase, where conviction matters more than fear. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.